Dividend investing is a great way to achieve the difficult but life-changing goal of reaching financial freedom. Today, we will explain everything you need to know about dividends, what they are, and how they are paid. At the end of the video, we will show you an estimate of dividend income over the long run and the amount that you need to invest to reach a given level of earnings. What are dividends? Dividends are a portion of a company's profit that is given back to its shareholders, and they can be seen as a reward paid to the investors who believed in the business and purchased shares. Not every firm pays dividends, and each company is free to decide almost every aspect of the dividend payment.
This is because the availability of profits to be shared with the investors depends on many factors, such as the industry and the market positioning of the company.
Generally speaking, only quite established companies that have already expanded to a large share within their target market and therefore do not need their entire profits for further business expansion can pay substantial dividends.
The majority of these companies operate in sectors such as utilities, oil and gas, and basic materials in which profits are almost constant and new competitors are not likely to enter the market, and each company has already expanded as much as possible.
On the other hand, a sector in which only a handful of companies can pay dividends is the technology sector. This is because this industry is always in development and companies must invest most of their dollars into R&D just to maintain their market position. How and when are dividends paid? The firm's decisions about dividends depend solely on the board of directors, which is the governing body elected by the shareholders to oversee management and decide the business strategies. The board of directors is in charge of deciding the method by which dividends will be paid, the frequency of the payments, and the amount. There are two methods by which the dividends can be paid, with cash or with additional shares. When a company pays dividends in cash, you receive the payment in your brokerage account a couple of days after the dividends are paid by the company. If instead the dividends are paid with additional shares, you simply receive the new stocks in your investment portfolio. Each of the two methods has both its ups and downs. When you receive dividend payments in cash, the amount that you receive was previously taxed by the firm as income tax, and now it has to be taxed again as long-term capital gains. On the other hand, when dividends are paid in shares, you simply receive the new shares in your portfolio, but you do not have any extra liquidity to diversify your investments or pay your bills that you would have had with a cash payment. The board of directors is also in charge of deciding the frequency of dividend payments. Generally, the majority of companies pay dividends either quarterly or semi-annually, but some companies pay them every month. The frequency of the payments depends, among other factors, on the nature of the sector in which the company operates. If a company is active in a sector very vulnerable to seasonality, for example, the sales in summer drop significantly and they boom in the winter, it could decide to pay the dividends less frequently to avoid using a large part of the profits during the summer. On the other hand, a firm with constant profits year-round might even decide to pay dividends every month to provide the investor with the luxury of constant dividend payments. Finally, the most important aspect of the dividends is the amount. The amount of dividends paid is expressed in percentage, and it is called dividend yield, which is calculated by dividing the dividend amount per share by the price of the share and then multiplying the result by 100. This percentage form makes it very easy for an investor to determine the dividend payment they will receive, because by dividing the dividend yield percentage by 100 and then multiplying the amount invested in the business, you will obtain your pre-tax dividend payment. Additionally, it is important to know that to receive the dividend payment, the investor must purchase the shares of the business at most the last business day before the ex-dividend date, which is the day when the dividend eligibility is running out. Then, the dividend payment itself could take up to a month from that date, because following the ex-dividend date, generally 2 business days later, there is the date of record in which the company registers all the shareholders entitled to the dividend payment. Finally, commonly, after a couple of weeks, the payment is made. In addition to the recurring dividend payments, a company might also decide to pay special or non-recurring dividend payments either together with the scheduled payment or individually. These payments might be announced following great news for the business, such as a particularly productive period for the company or the easing of future market conditions. By the way, subscribing to our channel will surely pay dividends in the future.
Dividend income expectation.
The amount of dividend income you can earn widely depends on the shares you hold in your dividend portfolio.
The S&P 500 index is generally seen as the benchmark for the majority of evaluations and comparisons in the market. If we analyze the current dividend yield of the S&P 500 and its trend in the last 100 years, we can notice quite a few things. First of all, the S&P 500 dividend yield has fluctuated around 1.5% to 2.5% in the past 30 years, and now it is sitting at 1.82% at 2022 year-end.
Secondly, if we observe the long term represented in this graph, we can notice that the dividend yield exhibits a downward trend, which is flattening out in the last 30 years. Even though the overall trend of the dividend yield is a downward trend or, at most, constant in the last years, there are a small number of companies called the dividends aristocrats, which could represent a golden investment opportunity for the dividend investors. Dividend aristocrats are the companies which have consistently paid and increased the size of the dividends for the past 25 or more years.
Generally speaking, these companies don't just represent a safer investment as they tend to have a large size and great market positioning, but the majority of these businesses also have an average dividend yield of at least double the S&P 500.
Thanks to these firms, it is possible to build a dividend portfolio that yields around 5% per year and which has the likelihood of increasing the dividend amount each year. If we take a dividend portfolio as an example, that is composed of a very good dividend-paying stocks that yield on average 5% annually, we can calculate the dividend amount we will receive annually based on the amount invested. If, for example, you want to earn an additional $100 per month, it would be necessary to invest $24,000 into dividend stocks with a yield of 5%. If instead you are aiming for an additional $500 per month, which sums up to $6,000 annually, you would need to invest around $120,000. Additionally, investing in these dividend stocks also has another benefit. The earnings from a dividend portfolio will not only depend on the dividend payments, but also on the appreciation of the stocks. As with other fundamentally good companies in the market, the shares of great dividend-paying companies will appreciate over time as well. So, if you have a $120,000 portfolio that pays you $6,000 in cash annually, the stocks are also likely to appreciate over time. It is very difficult to predict the annual growth of a dividend-paying company because the growth is not only based on the fundamentals of the company, but also the amount of the dividend paid. Dividend companies on average appreciate less per year compared to the non-dividend companies since they have generally almost reached their maximum market size. On the other hand, according to a study carried out by SureDividend.com, there is a handful of companies which are part of the dividend aristocrats that have a 5-year expected annual return even well above 15%. Of course, this projection does not apply to all dividend aristocrats, but if you can carry out a solid fundamental analysis and find great deals on the market, some dividend companies could generate an annual return comparable to the average return of growth companies, but with the added benefit of receiving part of the profit directly in your bank. We hope that you have a clear understanding of dividend investing now. See you next time.